Thank you for joining us for Student Loan Repayment Strategies. Find solutions that work for your budget. The definition of a student loan: it's a loan that is used to pay off education-related expenses, such as tuition, room and board, textbooks. Many loans have a low interest rate like Perkins loans or Stafford loans. In general, students are not required to pay back these loans until the end of a grace period, which usually begins after they have completed their education. There are different types of student loans, and I'm going to go over them now. The first one is a subsidized federal Stafford loan. Now, the subsidized federal Stafford loan is a federal student loan available to students with demonstrated financial need. Subsidized loans are among the least expensive loan options for students, because the federal government pays the interest while the student is attending college on at least a half-time basis and during other periods of authorized deferment. The unsubsidized federal Stafford loan is a federal student loan that is not based on financial need. Interest accrues on unsubsidized loans from the time the loan is disbursed by the school. The interest is not paid by the federal government. We also have direct subsidized loans. Direct subsidized loans are available to undergraduate students with financial need. Your school determines the amount you can borrow, and the amount may not exceed your financial need. The U.S. Department of Education pays the interest on a direct subsidized loan while you're in school at least half-time, for the first 6 months after you leave school, which is referred to as a grace period, and during a period of deferment, that's a postponement of loan payments. Direct unsubsidized loans are available to undergraduate and graduate students. There is no requirement to demonstrate financial need. Your school determines the amount you can borrow based on your cost of attendance and other financial aid you receive. You are responsible for paying the interest on a direct unsubsidized loan during all periods. If you choose not to pay the interest while you are in school and during the grace periods, your interest will accrue and be added to the principal amount of your loan. The next type of loan is a direct consolidation loan, and this allows you to consolidate or combine multiple federal education loans all into one loan. The result is a single monthly payment instead of multiple payments. There's also the federal Perkins loan or Perkins loan, and this is a need-based student loan offered by the U.S. Department of Education to assist American college students in funding their post-secondary education. The program is named after Carl D. Perkins, a former member of the U.S. House of Representatives from Kentucky. There's also what is known as PLUS loans, and these are federal loans that graduate or professional students and parents of dependent undergraduate students can use to help pay for college or career school. PLUS loans can help pay for education expenses not covered by other financial aid. Under the Federal Family Education Program, private lenders made federal student loans to students, and guarantee agencies insured these funds, which were, in turn, reinsured by the federal government. Now I'm going to quickly discuss the two words that you hear the most when you finish school or when you're discussing student loans. The first is forbearance. Forbearance is a period during which your monthly loan payments are temporarily suspended or reduced. Payments on your loan principal are postponed, but interest will accrue during the forbearance period. Forbearance is intended to help you out in times of temporary need. Note that the use of forbearance may cause the loss of borrower benefits, such as repayment incentives that can lower your interest rate for certain loans. Cosigner release for private loans includes a one-time payment requirement, and forbearance may delay eligibility. The next is deferment. Deferment is a period where you postpone making payments on your loan. Interest doesn't accrue on subsidized federal loans. You are eligible if you are engaged in a graduate fellowship program, rehabilitation training, internship, or residency, or teaching in a teacher shortage area. You are also eligible if you are enrolled in an eligible school at least half-time, or you are a parent with a Parent Plus loan who needs to defer repayment while your student is enrolled in school at least half-time. If you're having temporary issues making your student loan payments due to unemployment or economic difficulties, be sure to let them know as soon as possible to avoid becoming delinquent. If you are unemployed or working less than 30 hours per week and seeking full-time employment, you may be eligible for an unemployment deferment for up to 3 years. If you're working 30 plus hours a week but you aren't able to afford your monthly payment, you may consider a graduated or income-driven repayment plan, and I'll discuss those a little bit more later. Lastly, they have economic hardship deferment, and you may be eligible for an economic hardship deferment for up to 3 years depending on your situation. Now that we know what types of loans are available, and we discussed a bit about forbearance and deferment, let's get into the topic of this webinar. Before you get into payment strategies and plans, you have to know who you owe. And you're going to want to check out the NSLDS, the National Student Loan Data System. Basically, this is the U.S. Department of Education's central database for student aid. It receives data from schools, agencies that guarantee loans, the Direct Loan Program, and other U.S. Department of Education programs. The site displays information on loans and/or grant amounts, outstanding balances, loan statuses, and disbursements. Now, in order to use the NSLSDS site, you need to provide your FSA ID, username, and password. If you do not have an FSA ID, you can create one on the site. Now we're going to discuss basic student loan repayment plans. The first is standard repayment. Now this is offered at a 10-year term. Payments are a fixed amount, and you'll save the most money on this plan because you'll pay less interest. The next is graduated repayment. This is also a 10-year term. Payments will start low and then gradually increase every 2 years. You'll end up paying more for your loan over time than under the 10-year standard plan. And then lastly, there's extended repayment. This is a 25-year term. Payments may be fixed or graduated, and your monthly payments would be lower than the standard 10-year plan, but you will also end up paying more. And I want you to know that these sets of repayment plans are for federal loans and not for private loans, which we will discuss a little bit later on. Now we're going to get into income-based programs. There are 4 types of income-based plans. The IBR, which is income-based repayment, the ICR, which is income contingent repayment, the PAY is pay as you earn, or the REPAY, which is the revised pay as you earn. Now, eligibility for income-based repayment depends on which loans you have taken out for your education and when they were taken out. The following federal student loans from the Direct Loan and Federal Family Education Loan programs are the ones that qualify for application. Direct Plus loans, direct consolidation loans without plus loans that were made directly to parents and not as co-signers, direct subsidized loans, and direct unsubsidized loans, FFEL plus loans, which is the Federal Family Education Loan, FFEL consolidation loans without plus loans. If you do not have one of these types of loans, you may still be eligible for the IBR by consolidating your federal student loans into the direct loan program. And second, there is the interest payment benefit. If your new monthly payment isn't large enough to pay the accruing interest on subsidized portion of your direct loan, the federal government will pay it for you for a period of up to, but no more than 3 consecutive years once you begin